In this video, we're going to craft an earnings trade inside of Boeing. Now I'll start with the daily time frame chart. Boeing, I think, is at an interesting spot. We're coming up into what I expect to be previous resistance near that 233, 235 zone. We last touched that January of 2024. That's what's forming these two lines that we see, 233.85, 231.61. Now, what's interesting about Boeing is for the past 6 days, 1, 2, 3, 4, 5, and today, we've really just been chopping inside of this very tight zone. We also have earnings coming up next Monday, exactly 7 calendar days from today, and I'd like to find ways to take advantage of this very tight range. Now, before we do that, let's load in our pre-earnings indicator and try and understand what bias we have, if any, inside of Boeing. The pre-earnings indicator is available for free for all Volatility Box members. I'll leave a link to download it in the description box below. Now, if we start by taking a look at what our stats tell us, over the past 5 years, we have 20 earnings, so 20 data points that we're looking at. More frequently, price tends to fall as we head into earnings as opposed to rise, but it's not by a huge margin, 55% of the time versus 45% of the time. What is more interesting is the average move. On the downside, we fall minus 4.44% versus 2.64% on the upside. So a little bit more risk on the downside if you had to form a bias. Now, if you try to group the moves in terms of buckets, that's what these cyan labels tell you. And the quickest way to digest this is less than 3%, 3 to 8%, or greater than 8% moves. What we see inside of Boeing is a majority of the moves take place between less than 3 to 3 to 8%, more in the less than 3. Between 0 to 8%, we have 55 plus 35% of the total scenarios, near 90% of the moves being in that 0 to 8%. Now that's a wide range, so I'm going to use less than 3% since it seems like that's the one that happens more frequently. Now, if we take a look at what tends to happen as we go 14 days to earnings, 7 days to earnings versus 3 days to earnings, we can see that 14 days to earnings, we have the greatest move at 5.89%. However, if you compare 14 days to 7 days, you see that in between this, it's about 1.7% of delta, giving you this idea that it's really in that last 7-day period that you see the greatest move. Now here, we haven't seen that happen as commonly as we would have expected, so that tells me that there's a good amount of move potentially left here. I don't like the idea of a straddle. I think that's a little too expensive, at least for my taste, but I'll show you a way to craft a slightly cheaper strategy. Finally, if we take a look at implied volatility, we get this idea that implied volatility tends to fall more frequently, 60%, versus rise 40% of the time. What's interesting in Boeing, though, is the implied volatility percentile is currently at 7%. So it's really hard to fathom how much lower we can fall from here. You take a look at the chart too, and it feels like there's very little volatility. And I think that's likely to expand, and I'd like to find ways to play that without spending too much, almost like a lottery ticket. Now, if you were to come into the trade tab, first off, let's start with talking about your baseline. If you wanted to keep things simple, you might just purchase an at-the-money straddle. That's the 230 straddle. And the 230 straddle right now, if you were to purchase it by straddle, is quite expensive, nearly $1,250. Now, I want to find a way to cut that risk and find ways to participate in this idea, but not spending $1,250. So that's why I crafted this trade idea. It really forms from two different butterflies, having a middle period in which I'm okay losing money. When we lose money, that risk is capped at $115, which is the premium paid for this two debits. And if we make money, we have the potential to make a lot more. And it's not really these pins I'm looking for, it's more so for price to be in between these zones. So let me walk you through these two butterflies. The first one is a 220 and a $5 wide put side butterfly. And that gives us this zone right here. So between 220 to about 215.96 to about 224, we're making money. That's the zone that this butterfly gives us. If we come into our chart, 220's down here, 225 up here, 215 down here. So I'm looking for price to get towards that zone. Why that zone? If we take our price anchor, 220 is a little bit more than that 3% move, but again, to the downside, we're looking for a little bit greater of a move, so I rounded that up to 4%, and I like the volume in the 220 strike. So I think that is a good downside play. Now for the upside play, I have the 235 call side butterfly. Very similar in terms of price, but this is $5 wide on the upside. 230, 235, 240. So that's 235. That gives you a range basically between 231 to about 239-ish. If you come into the chart, 231 is a little bit inside of this zone right here, and 239 takes you to a little bit below this 240. Now, the one risk I'll call out is 240 is still not the gap fill, so you do have the risk of if we overshoot on the upside. If we do overshoot, that risk is capped again to the debit paid. So that's an idea that I like. It's much more cost effective, 115 of risk compared to the $1,250 that we saw for the at the money straddle, which would be another cleaner way to try and play this idea that we're looking for volatility to expand one direction or the other. I hope you found this video helpful in understanding how to use the pre-earnings indicator along with the options tab to create an option strategy that makes sense. Take care, everyone. Good luck trading, and I'll see you in our next update.